In this video, I'm going to show you how you can implement the wheel strategy the correct way to generate retirement income of $10,000 a month or more. Don't worry about smashing the like button, subscribing, or looking for the Discord and coaching link just yet. We're going to dive right into this strategy so I can show you how you can generate consistent income the correct way. We've all heard of the wheel strategy before. You sell puts to get into a stock, and then when you're in the stock, you start selling covered calls to get out of the stock. Your exit. You have a put as your entry, and then you have a call as your exit. However, a lot of people don't really understand the correct way to run the wheel strategy. They don't actually use the wheel strategy in a correct way to generate safe, consistent income, and they end up bag holding on their position. Most traders, and in fact, most financial coaches, don't even really understand how to run the wheel strategy correctly. The wheel strategy is actually a defensive strategy, not an offensive strategy. Now, if this were sports, that would make more sense, but it's not a sport. I'm going to explain to you guys and show you exactly what I mean because I used a sporting term to give you an example. You want to use the wheel strategy as insurance, hence defensive and not offensive. I'm going to show you guys everything you need to know in this video. But first, if you guys are having trouble understanding what's going on in this video, what I'm explaining or showing to you, I do offer a full training course, Discord, and one-on-one coaching. And I've had people ask me why I work so hard to help other people. And honestly, I grew up in a family that was Catholic, and my parents were very hard on me to help others when I could. So when I made my money in the stock market, I wanted to create a system to help others escape the 9-to-5. I really wanted to put in the work so that other people had an opportunity to achieve the same success that I had. Let's take a listen to what one of my students, Adam, has to say about my coaching and my Discord.
In just a short amount of time, the program that you offer, I've learned so much, and I've changed my entire approach to investing. You know, I'm much more structured, much more safe, and I've seen consistent, profitable growth. I've seen the growth. And it's almost like unbelievable. Like in a market that we're in now, I was still able to consistently grow because you're so, methodical and structured and you care about each student. I'm here to say it how it is, right? I've made consistent growth. So I started with $15,000, right? I am now at $40,000. Okay. And I'm so proud. It feels, amazing to be able to share this because I know that there's so many people that will do the same, right? You have to just trust Corey and trust what he's teaching and what he's offering because he means so well.
So you've seen on the screen the profits my students are making, taking $8,000 accounts into $23,000. And Adam, you've heard his story. If you guys are ever interested in joining, I would love to help you guys grow your portfolio. It's what drives me every single day. If you show up committed and ready to learn, I show up committed, ready to teach you everything you need to know. You can sign up at investorcorey.com. Again, the link's in the information box below. And I look forward to speaking with you and helping you on your journey when you're ready. The wheel strategy, when executed properly and set up in the correct way, is a very powerful strategy that can give you almost 100% win ratio. I know this sounds crazy because a lot of you have executed the wheel strategy before and lost money or you're bag holding. And I'll explain what I'm talking about. The wheel strategy is not to be implemented into your portfolio as an offensive position. You should not be selling puts looking to get into a stock. That is not how the wheel strategy is meant to be set up. The way I run the wheel strategy has given me a damn near 100% win ratio. It allows me to make profits and it ensures my portfolio. And I'm going to show you guys everything that I'm talking about. Let's jump into a chart right now. So as an example, we're going to use Wayfair. Guys, do not confuse this like many of the viewers and students have in the past. This is not a trade alert on Wayfair. Forget that Wayfair has earnings. Forget that. And forget that I'm specifically using Wayfair. This is just an example. It's an example of a stock in a downtrend and how to set all of this up. This is not me telling you to trade Wayfair. So this is an example of what you would not do. Let's split this back here and replay. This way we don't confuse you guys. And we're going to say the stock is looking just like this. A lot of people will see the stock consolidating and they would go ahead and they would sell a put right here at 50. 25 delta because the price is around 54, $3 down, 1 week out, roughly a 25 delta. So a $50 put would be good. However, what this does is it puts you into an immediate assignment. So you get assigned. You see, you sold this put, and then if we let this play out, look what happened. You received $50 for this put roughly on Wayfair, and now it's worth about $200, maybe $300-$400 more. By the time it all happens and you come to Friday, which is right about here, you're going to get assigned on this put. You can't buy this back at a loss. This is worth $700 on the day of expiration. So what's going to happen is you're going to get assigned. And when that happens, you're going to be getting assigned at 50 and the price is now 44. So now what do you do? If there's no earnings, this could take a month or two to recover. You're tying up $4,000, $8,000, $12,000, even if you have 3 contracts or more for 3 months. But let's just go with the example. You have 2 contracts. A lot of people like to trade 1 or 2. Let's say you sold 2 $50 puts. You have $10,000 in collateral. And if there's no earnings, which we're going to forget earnings is here, and this is like just a regular stock that is dumped, and you're going to see something like this, and it could take a couple of months. We could go all the way into mid-November, into December before you recover. So if it's 2 months, you're tying up $10,000 capital for 2 months. You know how much money you could make? On 10 grand, you could safely make 2 or 3 grand in 2 months. So that's all thrown out the window. And then what happens? The stock starts to come up, and as soon as it's up here around 46, you try to start selling $50 calls, maybe 49, maybe 51, and then the stock runs. You miss all of this. You're trying to buy the option back at a loss. You'll lose money on that. Then the stock will drop, and now you're stuck selling another call option when it's out of the money right here at 50 and the stock's back at 48. Or maybe the stock just runs so far up, you get assigned at 50 at your break even, and now in 2 months, all you've made is the premium of the call and the premium of the puts. So 10 grand made you $600 or $400 over 3 months, which is very low amount of money. Or you get assigned and the stock drops and you end up selling covered calls right here to try to make some of your money back. Stock runs, you get assigned at a losing position. So really what's happening here is you are either bag holding for a very small profit and foregoing a lot of potential profits on that capital because you're tying it up, or you're getting assigned and selling covered calls that are still below your entry because you're trying to make up that loss. The stock runs and you're either buying back at a loss or you're just exiting at a loss. Either way, you're either losing money or making very little. This is not how the wheel strategy is supposed to be executed. And this is the reason why you are losing money. The first and most important thing to understand, we're going to start at the ground level right now. Forget about all of this. We're going to start ground level, and I'm going to explain to you guys exactly what you need to know. When you're running the wheel strategy, we have to start with technicals and fundamental. You always sell puts on stocks that are declining and hit a support level. So number one, we need to find a declining stock like Wayfair and at a support. So in order to find out the support, we're going to see that the 10-day is below the 20 and they're both below the 100. It's oversold and below 30 on the RSI. So we want to look to the area of interest in the previous months or weeks. And we can see that although there's a lot of support here, the downward pressure is too great. However, we can see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and a couple more down here. So we can see there's a lot of support in the 41 and a lot more support in 43. So between 41 and 43, there's a lot of support. And with all of this previous support, it's highly unlikely the stock would break that. Now, if you're asking me, Corey, how do we know that? Well, that segues this into the number 2 most important thing when you're trading the wheel strategy to make money. You have to understand that the biggest illusion market makers and big institutions have created is that the stock market in its entirety is run and operating off of money. It's not. I know this may come as a shocker to you. When you think that the entire market is driven by money, it's actually not driven by money. Money is mainly the byproduct of what actually drives the stock market, which is psychology, fear, and greed. These market makers, manipulators, hedge funds, big institutions create fear of missing out, greed, the want of money, and that's what drives the market, and the money is the product of what they're driving. But what actually drives it is the psychology. When you unplug yourself from the market, from the matrix, so to speak, you realize that human beings all think alike, mostly, with some deviance. And because I have a degree and I also took psychology in college, and my family members also are involved in psychology, my dad's a psychologist, I've grown up in a household full of psychology, so I understand how this kind of thing works, and it really greatly helped me in the stock market. The stock market is basically tons and tons, thousands, millions of people doing and thinking and wanting the same thing. The moment you can step back and unplug yourself from this, you actually realize what's likely to happen and what's likely to occur in the stock market, because people think alike. I'm going to show you and explain to you exactly how, and I'm going to prove it to you. When the stock was down here, all the green candles, people were buying. When the red candles kick off, you can see people started selling and they get bigger. Then people start buying again. Then they start selling. The people that sold, the investors, traders, the people that sold in here, that kept selling off every single time the stock ran. What do you think those people were doing? Well, I know what you did. I know what you said when you were in a trade similar to this. You sold a stock as you thought it was consolidating, and then it ran. So here's what you said. If it ever goes down to $42 or $43 again, in this specific example that is, I'm buying it again. I know for a fact you've said it. Almost every single person in this situation is going to continue to do this even in the future. You sell a stock because you don't think it's going anywhere, or you take a small loss, it runs. If it ever goes back down, I'm going to buy it again. Okay, so since you said it, millions of people said it because we think alike. That's the human psychology, meaning this stock comes back down to here, and every time sellers keep selling off, these individuals that said they would get back in are now getting back in, which means the stock is going to consolidate at 42 and then it's going to run again. So this is the market. It is a big manipulation of psychology. If you can't understand the psychology and unplug yourself and understand what's going on with the technicals and fundamentals, then you're going to have trouble. So that covers two things. We want to time the stock in a downtrend and technicals and fundamentals. The psychology is number two. Number three, you got to pick good stocks that are likely to recover. Wayfair being one of those. We look at price to sales, price to earnings, EBITDA, total revenue, net debt. These are just some of the examples. Once we've picked a good company and we've done our due diligence, just like I've explained to you, then we can time it out. And what we would do is we would say, okay, this stock has now fallen and it's now consolidating this week, Monday, Tuesday, at say $43, $42, and it's found support. Once we see there's some support and we start leveling off and the 10-day comes back up to touch the 20-day, which could be sometime early this week, maybe midweek, we go ahead and we go below 42 or 43 and we sell a $40 put, which will be right here. A $40 put is worth roughly $50, I think. Let's verify that on Wayfair. Sell a put going out this week, a $40 put. It's actually a little bit more, but it's because of earnings. Volatility on Wayfair is usually 80%. So you figure we're losing 60% here. 60% times Vega at 0.0153 is going to give us, so at $12 to $15. So on a regular week, this would be worth about $70. So let's just go real modest and real safe, and we'll do $65, okay? And you sell two of those. So you're going to be making $130 per week. 130 times 4 over the course of 1 month, you would make $520. Now, looking at this chart, if there was no earnings, that is, the stock's consolidated, you sold this put due to the previous support area, highly unlikely this gets broken. So let's say you do this for 2 months and then, well, your average cost, let's say the stock comes up, comes back down and you start selling, or it just consolidates along the way. And after 2 months, it now breaks. If it breaks 42, let's say the stock after 2 months falls down to 37.50 down here and you get assigned. Well, you're getting assigned at $40, but your average cost is not $40. It's $1,040 in profits divided by 200 shares. So $5.20, which basically means your average cost is $34.80. So even though you got assigned at 40, $34.80 is your average cost, which means you are still ahead of the 8 ball, even though it's $37.35. So you're doing well. You're ahead of things. And then what's going to happen now? You're going to wait, because in the wheel strategy right now, you're ahead. You could actually start selling $40 covered calls or 41 or 42. In this situation, I would wait for some recovery and try to figure out what's going on. On the bearish side of things, if it looks like the stock's starting to go down, I would start leveling off $40 and $39 calls. I'd be selling them out real quick. As the stock drops, these would become worthless pretty quick. Then I would sell $38 calls. And as the stock starts to come up and recover, if it looked like you might get assigned, you would close them out at break even or a slight loss or a slight profit, wait for the stock to continue. So in this situation, you would be $1,000 in stock profits. 45 to 40 times 2 is $1,000. 500 times 2 is $1,000. Plus, you would have the original put premium of $1,040. So that's $2,040 plus your call premium. So in a 2-month window, in a bearish scenario, maybe 3 months, with the call options, maybe you get assigned on the second or the first set, but realistically, you could make another $200-300 on the call options in a week or two. You made $2,340 on 10 grand in 2 or 3 months, which shows about an 8 to 10% return, which is exactly what you would want from the wheel strategy. However, in a bullish scenario, the stock comes down and starts consolidating, you're assigned, you have 2 choices. You could sell the $40 calls, or you could wait a week or 2 for it to start to work its way back up. And then you can start selling covered calls at 44. The reason I say you could sell covered calls right away is because of the puts you sold, your average cost is actually $34.80. So if you sell covered calls at $39, this is going to help you in case of a bearish scenario, because in this case, a $39 call is going to be worth about $100. So you can collect another $200. If the stock drops, you just basically made $200 more for free, and you can do it again and again, wait for the stock to recover and start moving up, and then you could still exit at a profit. But typically, because you've sold the puts and waited for all this bottom to happen, you sold the puts, you get assigned, it ends up dropping down to 38 or 37.50. It's likely to consolidate, maybe drop a little bit more, and then work its way right back up. You've pretty much timed the bottom. So what I normally do is if I made $1,040 at this particular point in time, I would go ahead and I would sell another $235 puts. This would generate another $200 premium on 2 contracts. When the stock starts to come up a little bit, I'd buy these back at a 60-70% profit. And once it's up around $40 again, I would start selling out $44 short calls. And then if I get assigned on those, that is going to put me in a position where in 2 to 3 months, I'm making about another $200 to $2,500 or more, plus the couple $100 I made these puts. Now, this strategy, like I just showed you, is about 10% per month. So if you have a $100,000 account, you realistically will be generating between $8,000 to $12,000 a month. But you notice that with this strategy, selling these puts, the wheel strategy is defensive, because in this scenario, the chances of being assigned is very low. We timed this bottom, so the stock is consolidating here. We sell a 40, the stock could drop more, but it's highly unlikely to break that 40 because look how low it is. So I've been doing this for years, and when you time out the bottom similar to this, I've only been assigned 1 out of 10 times, sometimes 2 out of 10 times, and maybe once or twice in 4 years, I've been assigned 3 times out of 10. So it's about a 75 to 80% win ratio. So what we're really doing is the wheel strategy is actually not the offensive strategy. The biggest mistake that you can make for your portfolio is to go into a stock, like I'll show you way back here, and see the stock consolidating and then just start selling puts at 50 and then it drops. By finding a stock that's already made a big move downwards and is now consolidating and doing the due diligence at looking at the past history of the stock and getting to know the stock, you are now timing the bottom somewhat. And then you're going below that bottom by at least $1 and selling those puts, meaning the chances of you getting assigned are like 10 or 20% or less. So if you're running this strategy on 2 different stocks every single week, and you're running multiple contracts, you might only see an assignment on one of those stocks maybe once out of 2 months out of 8 weeks. You're making 8 trades, you'll probably get assigned 1, which means the wheel strategy is actually not the strategy, it is the insurance plan. The wheel strategy is the insurance strategy. You sell puts, you time the bottom, you sell puts, you time the bottom. When you sell these puts, then the stock drops, but you're not looking like you're going to get assigned. Drop more, sell more puts. And then when the stock goes up, you make money, and you do this over and over again. The wheel strategy is the insurance plan so that if my high valued and high success rate strategy happens to fail 10%, 20%, maybe 30% of the time, I now have the wheel strategy to turn this into a 100% win rate or a 99.99% win rate. Because once this happens and the stock price drops below $40, we get assigned. We sell some more puts down here. And then if it drops a bit more, maybe we get assigned on one, maybe we don't. We now hold, immediately sell covered calls because our break even is now $34.80, like I said. And the price is at 36, 35, 37, doesn't matter. We're still in the green. We can start hammering covered calls at 36 or 37. Make that $100 a week. It doesn't matter anymore because of our break even price. So to recap, we look at Wayfair, we're getting about $130 a week. Because we've timed this out and the stock is consolidating here and maybe bouncing around, we sold some $40 puts. This, in my opinion, is in 70 to 80% likelihood over 2 months anyway. So we've collected $1,040 in premium over 2 months. We get assigned and our average cost is going to be $8,000. So $8,000 minus $1,040 is $69.60 divided by 200. Average cost of $34.80. So even if the stock was to drop to $36, we could sell a $37 or a $38 call because we're already ahead. If the stock goes up, we can roll that short call or just get assigned and get out at a profit. But in a consolidation period like this, it usually happens for a week or two. So we can sell 37, 38 calls as it's starting to recover. We could buy back quickly to get out or roll and let the stock run and make more profits. And typically the stock will not fall below this point right here by much at all because it's already fallen, consolidated, dropped a little more. And usually 8 or 9 times out of 10, this is what happened. In the instance that it does fall a little bit more, we can now sell a few more puts, and that will usually be the dollar cost average because if we sell 2 more puts down here and the stock drops to say somewhere around here and we get assigned and it sits at 32, our average cost is now around 33-ish or 34, maybe a little lower. It's probably just a little bit lower. So at this point, we're almost at break even. We can now turn around and sell $36 calls every single week. And when the stock finally does run to 36, even if we get assigned there, we are still going to be between 7 to 10% profit per month. This is because we're utilizing the wheel strategy as an insurance policy, not the main strategy. You're supposed to sell puts near a bottom, and if you miss a little bit, that's okay. You enter the wheel strategy. Sell covered calls, keep selling them, let the stock run, exit at a profit and do it again. But realistically, the best way to run the wheel strategy is as a defensive insurance policy. And that's how I do it. I sell puts week in and week out. Sometimes I don't get into the stock for 2 to 3 months. Once I'm in, sometimes I'm only in for a week or 2 or 3 weeks and I'm out at a profit. The wheel strategy is actually the insurance policy for selling puts. And because I operate my portfolio in this fashion, I practically and virtually have no loss. My win rate is probably between 80 and 90% across the entire portfolio, and that includes aggressive, risky butterfly plays. If I was to only account for my selling puts and wheel strategy, my win rate is damn near 100%. I may have had 1 or 2 trades not go my way in 4 years. And it's because I've understood the psychology that you don't jump into a stock trying to sell the wheel strategy. You don't just jump in and say, I want to get in. I'm going to sell $54 puts on a stock that's $55 or $54. That's okay if you're bullish and you know the stock is going to run. But the wheel strategy is not meant to say, hey, I intentionally want to get into this stock. Why? So you can sell covered calls. If you're intentionally selling puts to get into a stock, that means you think the price is going to go down. If it's going to go down, your covered calls won't have the value to make you enough money. So you're intentionally trying to get into a stock that's falling and you're trying to get in now, collect a juicy premium, and then the stock drops and the premium means nothing. And what I mean by that is if you were to have sold a $50 put right here, I'll show you, $50 put right here, while the stock was 54, you would have collected $50, giving you an average cost of $49.50. The stock now has dropped all the way down here after 1 week to 44. You're $5 behind the game. Like you're $5 behind. That's not good. Your $50 did nothing for all of this move. Now you can dollar cost average. You can do that. So if you're the type of person to sell 1 put there, and then it drops because you're testing the waters, sure. Then you'd go down to 40, like I said, and you'd sell 4 more down here, giving you a nice, good dollar cost average that would be somewhere around 41 or 40. Now you're pretty much at break even. And that's good. That's really good. But you want to time things better. You should not be on a stock consolidating that has bearish sentiment and just aimlessly selling puts. Not intentionally for the wheel strategy, you should not do that. The wheel strategy is, like I said, your insurance policy. So you look to enter positions only on the bottom. In fact, I'm not even looking to enter the stock. I'm looking to find stocks, one, that are of good quality, profitable companies. Two, I'm looking at the psychology, previous areas, like right here, to know where the bottom is. Three, I'm doing my technical analysis and I'm watching the move of the stock to make sure it's hitting a support somewhere down here. Then I go below that at a 25 delta and sell puts down here. And if the stock drops and I get assigned, I wait for some more consolidation, sell more puts below that and sell calls right above, because my dollar cost average is actually below where the stock currently sits. So by selling puts right below the entry and right above, I make money. And I'll show you one more time what I mean. The stock actually drops, let's say, to right here. I sold my 40 puts. Stock drops more. I get assigned. My average cost is $34.80, but the stock is at 38. I will then sell two more puts at 36 and I'll sell covered calls at 39 or 40. Even though the stock is at 38, my average cost of entry on the put was 40. It's because I collected $500 to $1,000 depending on how long I was selling puts. So if the stock runs up and I get assigned here, I've made money here. I've made premium here. I also got out at the same price my entry was, and I made all the put premium here. So 500 here, 200 here, and another 200 here. So I'm into this for 1,000 profit on 8 grand over the course of maybe 2 months, which when you think about that, that's a lot of money. That is about 6% per month, 7% per month on a $100,000 account. That's $7,000 a month. This is very consistent way to run the wheel strategy. Almost guarantee you right now, you've probably not seen another coach explain the wheel strategy like this before. The wheel strategy is not an offensive play. It is defensive. The wheel strategy is the mother of all defenses. The wheel strategy is basically the, hey, I'm going to sell puts on this stock over and over and over again and just sell puts and collect premium and have no fear of entering. Because the moment I enter the stock, I've now entered the backup plan, the wheel strategy, and then I'm going to start selling covered calls. And where you really truly benefit from my method and my methodology on doing this strategy is because you've timed the bottom as well as I have, although it may not be perfect. It's given you such a good dollar cost average that the moment the stock comes below your strike price and you get assigned, you can sell covered calls only $1 above at a 35 delta for ridiculous premium. You can get out at a strike price that's below your put price and still make money because your dollar cost average is so low. In this instance, I was able to sell puts for 2 months, giving me an average cost of $34.80. Even though the stock dropped to 37 or even 36, I was still $200 in the positive. So if the stock dropped to 36, I could sell 37 or 38 calls and I could still get out of the stock and collect more premium on the calls. So as an example, let me show you exactly what this would look like. I collected $1,040 for 2 months, 2 contracts selling puts at $40. Now, granted, this is not just $40 puts. If the stock goes up, I'll raise my price to 41 or 42. This is just going off of the $40 puts because it's specific to a 25 delta. I always sell puts at a 25 delta. So if I start selling puts at 20 or 25 delta for 2 months and make $1,040, I now get assigned. And it is now $8,000, take away $1,040, gives me $69.60 is my total cost. Then I will now sell 2 covered calls at 38, which is another $200. Maybe I get $400 because I do it for 2 weeks. I am now going to take away $400 for 2 weeks. And then I'm going to get $38 for the share, 3,800 times 2. Oop, that didn't add up. Hold on. 65.60 minus 3,800 times 2, 1,040 profit. So again, when this is all said and done, I collect 1,040 profit plus the $200 I did for 2 weeks on the bottom puts, 1,040 plus 400. So 1,440 over the course of maybe, let's say 3 months. 1440 is about 20%. 20% divided by 3 months. It's about 6.6, almost 7% per month. So 7% per month times 12 months is 84% per year. I'm giving you a strategy that is 84% per year. S&P does 12%, maybe 14. This is a very good strategy. On a $100,000 account, you will make between 60 and 100K in your first year, probably more like 70 or 80K, like right where we're at now, 84K. This is roughly what I'm doing in my account. Now I've slimmed mine down to about 50% per year because when you start reaching in the millions, really want to tone it down. But this is a very good strategy. And 6% is on the bottom end. When it dropped down here and you sold these puts and sold these calls and the stock starts moving up, you could roll them out and higher and collect more profit on the stock. So you realistically could have turned that from $1,400, $1,500 profit into $2,500 profit. So this would have been more like a 9% per month return rate or 10. And you very well can achieve that. You should not be wheeling stocks that are startups like Serve Robotics, Enovix, SoundHound, SoFi, Palantir, Neo. These are not good stocks to wheel. You should be selling puts on stocks that are good, reputable companies in a downtrend like Amazon, Netflix, Google, Meta, Wayfair, Amazon, AMD, The SPY. Coca-Cola is decent, but not lucrative enough as far as options. The SPY is great. Tesla is good, but it's not that safe because it's so volatile. On the SPY, this is a very, very good strategy. In fact, the SPY is a prime candidate, as is IWM and other ETFs. So you have to understand that the wheel strategy is indeed a defensive strategy. It's meant, in short, that when you're selling puts consistently, that eventually you're going to be assigned. 2 out of 10 times you're going to be assigned. When this happens, wheel strategy kicks in, and now you take that 2 out of 10 trades, which is 20%, your 20% loss, you now turn that into a 0% loss and 100% win via the wheel strategy. The wheel strategy is not meant for you to immediately pick a stock and look for an entry. It is for you to pick a stock, find a bottom, and sell puts where you're unlikely to get assigned consistently. And then when that happens against you, enter wheel strategy. If you take the approach that I am teaching you right now, your win rate is going to go from 30, 40, 50% to like 60, 70, 80% or higher. And if you hold and sell the calls and the average puts after you're assigned, your wheel strategy is going to nullify pretty much almost every, if not every, loss you ever have. This is how the wheel strategy is meant to be implemented, because you're going to make great money on the covered calls and you're going to make great money on the puts that you sell after you get assigned on your first puts. However, the puts that you're consistently selling that you're not getting assigned on are printing you 5 to 10% per month with zero risk. It is like having insurance for your car. You don't worry about wrecking your car because you know you have insurance. When you sell the puts on stocks, you're not worried about being assigned because you have insurance, which is the wheel strategy. The only downside with the wheel strategy as insurance is that the stock could continue to tank, which is why you only do this when you found a bottom. Stocks that are working in a downtrend and are now consolidating and have good, strong support. You've done your due diligence, your research on the stock, or you're doing the strategy on the SPY, which over the course of a year or two is extremely and almost impossible to go in a downtrend because it's not a trend if it's not continual. The SPY might pull back for a little bit, maybe 6 to 8 months, and then run again. And that's only happened like a handful of times in 60 years. So the SPY is the perfect candidate for this. I was just using Wayfair as an example. Now, with this strategy, selling puts, if you were to have sold, let's just say, because you're going to diversify in a $100,000 account, you don't want to put any more than 10% into one position. So you would do 2 on Wayfair, you would do 1 on Walmart, you would do another one on maybe Tesla, another one on Apple, and you would diversify your $100,000 account. But to keep things simple, we would do $100,000 worth of Wayfair in this video just to get an idea of what 100K would return you in the stock market. Remember, if you're enjoying these strategies, but you may be having a little bit of trouble understanding them. I would love to help you, fam. I offer full Discord training course and one-on-one coaching, and I go over all of these types of strategies. I have students that started with 8 grand and turned it into 23 grand in 3 months. Other students that started with 300,000, just like some of you may have, turned it into 420K in 3 months. 120K profit on 300,000, 33% return in just over 3 months. I already have millions of dollars. I don't need to make any more money. I'm already trading, making that money to supplement my account. I do this because I love teaching and I want to help you. So if you need more help and you want to retire and this is still confusing you, I would love to help. You guys can sign up at investwithcorey.com. The link is in the information box below. And you can listen to the testimonial from Adam earlier in this video to hear what he had to say about his experience with me as his coach and in the Discord. But this is a really big strategy. It really is. The wheel strategy is strong, and I'm going to show you exactly what you can make on $100,000. But if you're looking to sign up for the coaching and you want to improve your portfolio, I look forward to hearing from you, fam, whenever you're ready. So let's go over to Wayfair, and on this $40 put, it's only worth 65 outside of earnings. So if we were to sell 20 of these, it'd be 78 grand. We could probably do 30. Not quite. Maybe we'll do like 26. No, 25 to be safer. On a 100K portfolio, 25. You generate $1,625 a month. So if you're diversifying your account the way I'm telling you to, Tesla, Wayfair, Apple, Amazon, Google, you've diversified it so your whole 100 grand is in use, but in different companies and not the same sector. So if you're in Wayfair, don't do Walmart. If you're in Tesla, don't do Rivian. If you're in Amazon, don't do Wayfair. You got to diversify. So maybe you do Wayfair, you do Tesla, maybe Nvidia and Microsoft, and then you'll move over to a different sector. Maybe do Johnson & Johnson, something like that. You want to make sure you're in different sectors so that if the medical sector and the, I guess you could say the EV sector or automotive sector tanks, it's not going to affect your stocks like Wayfair or Walmart or Amazon. You're not going to get affected by all of them. If you diversify the proper way, which is for another video, you'll have 25 contracts to be the equivalent because it's the full 100K. So your full 100K is in the market, different puts, different stocks. You know, you're all spread out and diversified the right way. 100 grand is going to bring you on a 23 delta. You're looking at about $1,600 a week. Okay. So $1,600 a week, that's fairly modest. Honestly, you probably get a little bit more, quite honestly, because this is a little modest on $65. We'll do it modestly so that, you know, it makes up for possible small potential losses. We times this by 4 right out the get-go. Just on put selling, you're at $6,500 roughly, maybe a little more. You might be closer to 7, but we're already at $7,000 a month income. Now, if you get assigned on these stocks, you're going to make more money because once you enter the stocks, you're appreciating from the stock itself and the covered calls. Once you're in the stock, let's say you did 2 months, okay, 2 months, you made 13,000, okay, 13,000, and then let's say 25 contracts, you're assigned. Wayfair goes to 38, you know, jumps around, drops to 37, comes back up to 38, and you sell $42 calls. $4 out of the money. That is the equivalent of selling $49 calls right now, roughly. So that's going to generate, outside of earnings, is going to be about $70, 65, $70. So we're going to sell 25 of these. You're going to generate $1,750 a week. Okay. Now, let's be even more modest. You spent 2 months selling puts, you get in, and let's say you only sell these calls for 2 weeks, the stock runs, and you're out. Okay? 2 weeks and you're out. 13,000. We're going to do 1,750 times 2, which is 3,500. You got into the stock at 40. You got out of the stock at 44 or 42 maybe, because the stock dropped below 40. It's 38. Let's say you sold $42 calls, which is $4 out of the money, same as this call is right now, $4 out of the money, 45 to 49. So you now get out at a $200 gain on those 25 contracts. So you made $3,500 in 2 weeks, plus you now have 25 times $200 gives you $8,500 in 2 weeks. And then you add up your $13,080 from the first 2 months that you sold puts. You're only 10 weeks in, 2.5 months in at 21K. Divide that by 2.5 and you're $8,600 a month average. You're pushing 9% return. Now, in another scenario, 1,750, you sell these puts for Let's say the stock just consolidates at 38, 37, 38, 37, 30. It's not going anywhere. So you sell these calls for 2 months. So you times this by 8, it's 14,000. Then you get assigned at say 42, 43, maybe 44 because you're going up higher. Now you're going to add 25 contracts times 400, 24,000 plus the original 13,080. You made 37,000 in 4 months. Divide this by 4, 9,200 per month average, over 9%. So in 4 months, you started with 100, you now have $137,000. No matter how you work this, the numbers are going to be the same, fam. If the stock had a drop from 38 to 36, you would have sold a 39 call. If the stock runs, you get assigned at 39, you would just go back to selling $36 puts. I promise you, at the end of the year, the results are going to be relative. They're going to average between 6 to 10% per month, maybe more. But the average for me that I've been getting has been 6 to 8%. I'm consistently like 7 or 8% every single month. So if you have a $200,000 portfolio, you're going to be generating about 14 to 15K a month. If you have a $100,000 portfolio, you're going to be generating about 5 to 7K a month or more. This is a very powerful strategy. And what makes it so powerful is that you're not relying on the wheel strategy to make the money. You're selling the puts, doing your due diligence, and using the wheel strategy as your insurance policy so that your put selling strategy is 100% most of the time flawless. And this is what makes the wheel strategy so powerful. A lot of other coaches, if not no other coach that I've ever spoke to, mentions it like this or teaches it like this. Now, I have students in my Discord, like at this point in time, I have probably close to a dozen students that have specifically mentioned other YouTube gurus and coaches and internet coaches. I'm not going to mention the name here, but they have signed up for my Discord and coaching. And after 2 to 3 months, they have made way more money, been way more confident and consistent. And it's because of things like this. If anyone is telling you that the stock market is all technical and financial, they are lying to you. It is 100% psychology that drives the market. And the reason this is because every time you see a green candle going up, it's likely to go up for a little bit and then drop. Why? Because everybody's looking to take profit. Why is the green candle going up? Because everybody's buying. Why is this big red sell-off happening? Because everybody's selling. What is the key word that I just mentioned to you guys multiple times? Everybody. Because that's what the stock market is. Millions of people all doing the exact same thing and thinking the exact same way. And the moment you unplug, you can step back and say, I know what's going to happen here. Everybody's buying this green candle. It's going to sell. And it did. Oh, everyone's selling. Let's buy. It's going to run now. And it did. It is all psychology. Money is the byproduct and the driving force of the psychology, but the psychology, the fear, the greed, the FOMO, this is what drives the market. When you have a handle on the psychology, and because my family, a lot of them, a bunch of psychologists, Catholic church-going psychologists, and it sounds really weird, but that's what they are, all psychologists mostly. So my family is a very religious Catholic family, but there's multiple psychologists in my family that I grew up around, my dad being one of them. And it really is strengthened me to understand and think outside the box and to unplug myself from these situations. Then I took psychology in college. And this is what I'm trying to tell you guys. Forget all the nonsense that people spread about the wheel strategy and the stock market. Understand the psychology, fear, greed. Think, what are other people going to do? I see red, other people are going to sell. You know it's going down. You know that it's going to go down. Time it on the bottom, then use your technicals, fundamentals, understand the stock, then go below that price from previous areas and sell puts at a price it's unlikely to go to, and continue to do this and print money like it's going out of style. And then those rare instances where it goes against you, capitalize, bam, on the wheel strategy. Now you're 1 or 2 out of 10, your 10 to 20% losses turn into epic, and I mean epic wheel strategy plays that now print you even more money. This is the secret. If you guys enjoyed this video, I hope you did. Give it a thumbs up. We'll catch you on the next upload, and I'll see you in the Discord and coaching if you guys want more help. One love, fam.